Looking to part ways with complicated, expensive, and uncertain shipping? Then give your business the edge it needs with USPS Ground Advantage shipping from the United States Postal Service. Keep everything simple with clear, upfront pricing and no unexpected surcharges. Keep things affordable with some of the lowest prices out there. And keep it all reliable with on-time ground shipments. It's time to turn shipping to your advantage. Learn how at USPS.com/advantage. USPS Ground Advantage. Simple, affordable, reliable.
Families have a lot going on. Let Ollie help manage the mental load with new cognitive help supplements for everyone 4 and up, like delicious Lolly Focus Pops or Lolly Mellow Pops for kids. And for parents, try 3 new Brainy Chews to help you focus, chill out, or get energized. Find these cognitive health buddies for the whole fam at ollie.com. That's OLLY.com. These statements have not been evaluated by the Food and Drug Administration. This product is not intended to diagnose, treat, cure, or prevent any disease.
This is Optimal Finance Daily, episode 2750, The 4 Pitfalls of Financial Planning by Lisa Whitley with WomenWhoMoney.com. And I'm your host and personal finance enthusiast, Diana Merriam. Now let's get right to it and continue optimizing your life. The 4 Pitfalls of Financial Planning by Lisa Whitley with WomenWhoMoney.com. Quote, "If you don't know where you're going, you'll end up someplace else." Yogi Berra. This, without question, is my favorite quote about planning. It encapsulates, as only the great baseball coach and manager could, the very first pitfall of financial planning, not having a plan at all. But that's not you, right? Common mistakes in financial plans. You have goals, you have priorities, you have a plan. And yet, Number 1, does your plan jump to a solution without addressing the root cause of the problem? It's disturbingly common in personal finance to conflate a specific tactic, a great money move everyone should make today headline, with an actual enduring answer to a financial problem. For example, you have high interest credit card debt, and your plan is to refinance the debt at a lower rate. Could be a credit card balance transfer, a debt consolidation loan, or even a home equity loan. Refinancing will lower your overall interest costs and allow you to get out of debt faster. That sounds like a solid plan, doesn't it? But what if you haven't changed your spending habits that led to the debt in the first place? Are there long-lasting, perhaps even challenging choices you need to make on either the income or spending side to address the root cause of your debt problem? If you haven't addressed the underlying reason you have high interest debt, refinancing will likely not lead to being debt-free in the long term. Number 2, does your plan overlook sources of risk in your financial life and then fumble the response? Stepping back, when we encounter any risk in our lives, we have several ways to respond. We can simply ignore the risk, transfer the cost of the risk to someone else, or accept the consequences of the risk ourselves. When we purchase health or auto insurance, that's an example of transferring the economic risk of illness or a car smash-up to someone else, that is, an insurance company. When we raise the deductible on our homeowner's insurance policy, we consciously absorb more risk ourselves while still transferring much of the financial risk of our home suffering damage. But what about the risk of becoming disabled and unable to earn any income? According to the Social Security Administration, 1/4 of 20-year-olds today will experience a disability sometime during their working years, and the causes of disability may not be what you think. The 4 most common reasons why a worker becomes disabled and at least temporarily unable to work are musculoskeletal disorders, tendinitis, arthritis, etc., cancer, pregnancy, and mental health issues. What is the proper response if this is now on your radar as a real risk? As in the previous pitfall, don't immediately jump to the solution that seems most obvious, in this case, disability insurance. If you have a healthy emergency fund or a second earner in your household, you may feel quite comfortable absorbing some of the risks yourself. Self-insuring, at least for the short term, and purchasing long-term disability insurance may be your ideal solution. But what about the risk of losing your side hustle income? According to a recent study, about 25% of American workers have some amount of non-standard income from work, such as freelancing. For lower income households, the percentage is much higher. Is the pay you earn from self-employment or even overtime at your primary employer truly extra? Or is it integral to meeting your day-to-day expenses? If the latter, how are you factoring the possibility of losing that side income into your plans? The possibility of incurring tremendous expenses for long-term care at retirement age is an area where many people, quite understandably, prefer to simply ignore the risk altogether. Yet we know from research that the average cost of long-term care could be as much as $172,000 over a lifetime. Identifying the optimal response to this risk, transfer, that is, buy a long-term care insurance policy, rely on Medicaid, or self-insure, that is, amass extra savings, will require a fairly deep analysis of your realistic options. A retirement plan that's blind to this risk is not a plan worth having. This is a complex decision you may want to make with the guidance of an experienced financial professional. Number 3, does your plan see the trees so clearly that the forest is completely missed? This pitfall can derail your financial plan in a myriad of ways. For example, perhaps you've heard the phrase, "Don't let the tax tag wag the investment dog." Of course, all things being equal, you would enjoy paying less in taxes than more. When things go awry is when, in an effort to optimize your tax position to the nth degree, you lose sight of the actual goal. Are you putting 100% of your long-term savings in a tax-advantaged retirement account, overlooking the benefits of flexibility and having penalty-free access to some of your savings before the age of 59 and a half? Or letting tax considerations drive short-term trading decisions rather than a deeper understanding of your investment philosophy? But this pitfall rears its head in other ways as well. Was your decision to buy a house driven by the numbers, completely ignoring the lifestyle implications? As well, there's the too tired for words latte budget example. Is your financial plan so focused on tracking the minutia of your daily spending that you've ignored the factors really driving your financial crunch, your rent or mortgage, car payment, or even your salary? And number 4, does your plan ignore what makes you you, the personal biases and quirks that affect your financial behaviors? Your financial plan, developed on the left side of your brain, envisions you saving dutifully for retirement or a house down payment. Alas, the right side of your brain has other intentions that include an overseas vacation. Your investment strategy may be to stay firm in equities for the long haul, except you shudder and sell at the first sighting of a bear market. Or conversely, your irrational exuberance for the next big thing leads you to consistently go off script in search of a better idea. Automation, auto-investing, and auto-rebalancing, dear listener, must be part of everyone's financial plan. More broadly, you must know thyself and have a financial plan incorporating tactics to save you from your own worst habits and negative financial decisions. Closing thoughts. A plan is rarely, if ever, perfect. Still, the wrong strategy can leave you someplace you don't want to be. Review and monitor your financial plan regularly to avoid these 4 common mistakes. Addressing your plan as life changes will ensure it keeps up with your dreams and money goals and provides financial security for your future needs. You just listened to the post titled, "The 4 Pitfalls of Financial Planning" by Lisa Whitley with womenwhomoney.com, and I'll be right back with my commentary. It goes without saying that a lot of people don't know where to start when it comes to investing. Many think you need a lot of money to invest. Some put off investing because it doesn't seem urgent. Acorns makes it easy to start automatically saving and investing for your future. You don't need a lot of money or expertise to invest with Acorns. In fact, you can get started with just your spare change. Acorns recommends an expert-built portfolio that fits you and your money goals, then automatically invests your money for you. And I love Acorns because I feel that this type of automation is exactly the boost needed for the many people who like the idea of investing, but haven't felt ready to begin for whatever reason. So head to acorns.com/OFD or download the Acorns app to start saving and investing for your future today. Paid non-client endorsement. May not be representative of all clients. Tier 1 compensation provided. Compensation provides an incentive to positively promote Acorns. View important disclosures at acorns.com/OFD. Investing involves risk, including the loss of principal. Please consider your objectives, risk tolerance, and Acorns fees before investing. Acorns Advisors, LLC. Acorns is an SEC-registered investment advisor. Brokerage services are provided to clients of Acorns by Acorns Securities, LLC. Member FINRA SIPC. For more information, visit acorns.com. Looking to part ways with complicated, expensive, and uncertain shipping? Then give your business the edge it needs with USPS Ground Advantage shipping from the United States Postal Service. Keep everything simple with clear, upfront pricing and no unexpected surcharges. Keep things affordable with some of the lowest prices out there. And keep it all reliable with on-time ground shipments. It's time to turn shipping to your advantage. Learn how at USPS.com/advantage. USPS Ground Advantage. Simple, affordable, reliable. This article reminded me why crafting a financial plan requires a bit of discernment. While there's a ton of great financial knowledge to take into consideration, the thing that matters most is considering how that guidance may or may not apply to your specific situation. Instead of following a one-size-fits-all approach, it's essential to tailor your plan to fit your specific circumstances. Common financial goals like paying off debt and saving for the future are universal, but there are many different roads that lead to the same destination. Also consider that a financial plan isn't a static document. It's a dynamic process that requires regular review and adjustment. Life circumstances change, goals evolve, and external factors impact your finances. Being proactive and adaptable ensures that your plan remains relevant and effective over time. So when crafting your financial plan, take a thoughtful and personalized approach. By paying attention to the nuances of your financial situation and staying flexible, you'll build a plan that aligns with your unique needs and aspirations. But that'll do it for today. Thank you for being here and listening every day. And I'll see you tomorrow, as usual, where your optimal life awaits.